Everybody, I'm going to get started in just a few minutes. Welcome, but people are still coming in from the waiting room. I want to give you a second to fill up a little bit, and then we'll kick this thing off. Thanks for being on time. Appreciate it. All right, people are still coming in, but I'm going to get started. Welcome, everybody. My name is Geoff Dohrmann. I'm the Chairman and CEO of Institutional Real Estate Inc., the publisher of Institutional Real Estate Americas and several other real estate publications around the globe. For the last few years, we've been doing this joint venture webinar on a quarterly basis to provide you not only with an update on what's happening with the NCREIF ODCE Index, but try to pull back the curtain so you can get a little understanding for what the drivers are that are causing changes in it. And the reason we're doing this as a public service and not charging for it is we know a lot of you are benchmarking to the ODCE. And so understanding what you're benchmarking against is really critical. It's mission critical for almost all of you. And for those of you from the private wealth advisory marketplace, from our real asset advisor community, a lot of you are looking for benchmarks to be able to benchmark against the investment programs that you're recommending to your clients on the private market side of the house. And ODCE is being used by most institutional investors today to benchmark at least their US investments. So it's a really good proxy for you. Today's webinar is being recorded. After it, if you registered for it, you'll get a link to that recording and a link to the slides so you can download them so you don't have to scribble like mad. You'll have access to the slides later if you want to take them and really spend time digesting them. And I really encourage you to do that. You know, data has a way of slowly revealing its mysteries. And what's important is that you have time to really digest it and think through, ask your own questions, and try to tease out the meanings that are underlying the data. The other thing is we're going to be allowing you to pose questions to our presenter today, as we always do during these, through the Q&A button. So you can see that down at the bottom of your screen where it says Q&A. So I have to just pop in that. I'm going to be looking at that. Garrett's going to be looking at that. And I'm going to be stopping him in mid-presentation to pose those questions as they come up. We usually get anywhere from 20 to 50 of these. Usually we're able to answer them all. We did a webinar on valuations the other day, and we still had 19 questions left that we couldn't get to. That's how engaged the audience was. So feel free to be engaged. This is here to answer your questions, not just to present information. At any rate, without further ado, I'd just like to introduce our presenter, Garrett Zdolshek. Garrett is the portfolio manager for IDR. They run a series of funds, two of which are ODCE funds. So that means that he, as portfolio manager, is focusing exclusively on the ODCE universe. And so it's his job to really understand and dig deep underneath these indices because he's putting his capital at risk in that market. So I think you're in for a good overview. We're looking at the whole year in review last year. And again, without further ado, take the podium is yours, Garrett. Go ahead, take it on.
Jeff, thanks as always. Really looking forward to this conversation. And as you mentioned, please ask questions. The attendees, please feel free to ask me to focus on things that matter to you. These are some of the things that we think about and matter to us. So, each quarter we tend to try to follow, and I think you can see my screen, right?
Yeah, no, it's showing.
So, each quarter we tend to follow a high level format, of talking about the market. This is 2024 in review. But, at year ends, we really like to try to focus on what do we also see going into 2025. So I hope to share some of that. The second piece is fundamentals, which again, I think it's always interesting to look back, but it also matters much more going forward and what that means for returns and values going forward into 2025. And then finally, I think, where there's probably the least amount of transparency in the market is capital flows, where capital is coming, going, and why, and and how it's coming and going. So we'll share some of the traditional Q info, but we also took a little deeper dive into that to look at some of the impacts driven by, investors versus funds, selling, sending capital back, buying, those kind of things. So, without much ado, maybe I'll start with the market overview. First meaningful quarter of positive return. I say meaningful. This is the second quarter of technically positive returns for ODCE overall since the cycle began. Last quarter, 3Q was, just barely positive basis points. This quarter, more meaningful 1% total return, largely driven by income. But the appreciation return was positive again, which again, I think is, a clearer sign that the recovery has begun. Last quarter, when we did this, I said I thought we were going to see positive returns going forward. And so I don't think we were first in saying the bottom has begun, but I think at this point now the majority of capital believes we have seen the worst and the recovery is in full swing. And so a great question, I think. If rates stay fairly stable this year, what might that mean for performance from this asset class? And that's something we hope to kind of drill deeper into as we go through this. We absolutely believe we are a new investment regime. So I'm going to give a little background to then answer the question. And we do have a projected performance number for ODCE. Again, I'm not going to tell you we're perfectly right ever, but you have to start with a basis. So we start with kind of the investment regime we see today. I think first, and we'll address this more, we do see public market returns, especially equities, being lower going forward. As we talk to all our clients, there is a clear change in asset allocation given the run-up in equities. Two, I think we see higher volatility around rates, and certainly rates will, in our view, stay higher than they bottomed at. Not necessarily extremely high in a historical basis, but higher and more volatile or more uncertainty. Three, we think we're going to see higher inflation than we've seen historically, in the last 10, 15 years. Not at the peak, but kind of coming out of the GFC for 15 years, inflation was very, very low. We think it'll be more than that going forward. But at a minimum,
what would you say it would be? Wouldn't be more than, but wouldn't be less than?
well, obviously inflation with COVID peaked, extremely high, right? 7, 8% or whatever it was. By no means am I saying it stays around that level. But 1 to 2%, coming out of the GFC, is maybe a little low too. So, kind of that 3% inflation range feels more reasonable to us, which is higher than, maybe the Fed wants, but not necessarily extremely high either. But at a minimum, I think we're going to see more uncertainty around it. Okay. And I think lastly, again, those 3 points really just lead to higher volatility across markets overall. And when I say volatility, it's the uncertainty of which direction, do tariffs cause inflation or not? There's views on both sides. Why will inflation stay stubbornly high or won't it? There's views on all those things. But what's clear is there's no clear consensus. Clear as mud, right? And so all of that in our mind points to hard assets, to owning buildings and owning return streams at a good basis, and that can't be replicated for less. In other words, you can't build it for less than you own it for today, and that seems to be broadly true across virtually all real estate today. Um, so there's a long, long way of getting back to the question. Our 1 year outlook for 2025 is about a 7.5% net total return to investors. Again, I think there's downsides and upsides to everything. But looking back and forward, I think if it is a 7.5, it's going to look pretty attractive, given that, a big piece of that will come from income as well. Um, so, I think kind of maybe a couple questions, Jeff. Do we want to hit these now? Okay, so there's a question about where do we see the sector performance being, rates being higher. And again, I think look at the day end rates, and you have a different view, right? Like a month ago or whatever, we were talking about 5% rates. We're sub 420 this morning. That's creeping up a bit. So again, it's just the volatility in the market. I think you have to ignore the noise from day to day and think about the long term a little more. We'll certainly talk about sectors in a minute and in the main food groups as well as the alternative property type sectors. So we'll hit that really hard. I think the other question about this administration and its outsized impact, positive, negative on specific sectors of ODCE. Again, I think that uncertainty, it's not clear. I think there's both scenarios. I think it has massive impacts on all investment markets, not just real estate. So, I think we can talk more about that in the sectors as well. Um, so this cycle, right, was a quarter longer than the GFC, although for some reason, I lived through both. The GFC seemed like it was over in a flash, maybe because it was so bad, everyone forgot about it or wanted to forget it. This seemed more like, paper cuts every day. Not that bad, but just not great either. So I don't know. It did feel longer than a quarter of cycle, probably too, because we're not really into the, true upside or total return backside of a cycle. So ask us how we feel maybe a year from now, and we'll see if we felt like it was worse or not. Values are basically 25% below peak. So, a 25% discount to peak pricing. Again, the GFC was, just under 40%. So, not nearly as steep as the GFC. I think that will have an impact too, certainly on return going forward, which is why we're not predicting double-digit returns like the GFC saw. But I think we'll see reasonably good, outcome and fundamentals resetting a bit.
So going back to capital markets fundamentals, Julianne Booker had a question. Thoughts on treasuries? Rates are only a small part of the overall cost of debt. We don't have a crystal ball, but I'm curious what you think treasuries are going.
Well, I think our assumption is they're going to be volatile, but they're going to settle in about where they are over, they're going to be higher than today at some points over this next year and lower than they are today. And so we're not really banking on rates, solving the return outlook here. In fact, I think in some scenarios, it's almost the, you know, perfect porridge of just right when rates, don't necessarily go to 2 and cause huge appreciation and destroy all our income going forward, versus also leaving some growth in the market to really grow that NOI. I think most of us would take a, 7 or 8% prolonged return over a lot of volatility of double digits and negative returns. And so I think, treasuries are a big part of the base rate, and then you have the spread. Certainly it seems as if spread is coming down, more capital is available to real estate, whether it be the the debt side of the balance sheet or the equity side of the balance sheet every day. There's more capital available off a very low number, obviously. So, it feels like that is increasing as well.
Another question, but this from an unnamed participant. If the return drawdown over the past 2 years was mainly caused by the valuation impact from the lurch in nominal rates, why is the market characterizing the fourth quarter as the initial stages of quote recovery? What is
Well,
there to
yeah,
what is there to recover if the market doesn't expect valuation rates to go back down? Perhaps a
well,
recovery
yeah.
in transactions and financing? Sorry,
I'm
this is a
sorry.
long
Yeah,
question.
it was. I think recovery is characterized as positive return going forward, and not necessarily just looking at the value like of a cap rate today. So the value decline was overshadowing the cash flow and growth of cash flows over the last basically 2 years, right? Which led to negative total returns. Whereas I think, in an asset allocation, as long as all the pieces are at least positive, there's some future growth and momentum. And that's the recovery we're talking about. We have very little assumption about like cap rates getting lower. It's much more on the operating side and the fundamental side of the business that we see positive return.
Okay.
You know, so as we look back, I kind of alluded to this, in terms of the cycle and inflection points, we are seeing the exact same kind of early impact that we saw, again in the 90s and the, you know, 08, 09 GFC financial crisis. And that's basically when the total return turns positive. If we go into first quarter of 2025 with a positive net return of any sort, the trailing 1 year return will actually turn positive as well. So, we think next quarter we're going to see a positive 1 year total return. Um, and that's historically been the start of this new cycle in recovery and returns, not just values, but total return, which is what the blue bars are showing. Again, the 5 year may not ever dip below, negative return in this cycle by the blue line. But certainly, again, we think that means the total returns looks more like that 90s cycle than the GFC cycle. And again, I think just to get perspective around it, these are the negative quarterly total returns. I mentioned 3Q was just barely positive. It was basically flat as far as I think of it, but 1Q, 1%. And we think that's going to grow. Also, when you add in kind of the range of returns, so the green is the best performer, not the same fund, but just the best performing fund of each period. And then the red is the worst performing fund in each period. Again, not the same in each period, same fund. But you can then see the range of return and, where everyone starts coalescing here is around 4Q, which again gives us, some green shoots and views that we have, seen the bottom, and we are seeing the positive returns coming back across the board, not just, one or two places. In terms, and there is a typo here. This says 3Q summary. This is 4Q. The property types continue to adjust primarily from market value. So, about 80% of the value or of the weighting change comes from market value, and the other 20% typically comes from buying and selling, active decisions, if you will, which is why it's so hard to keep existing portfolio balanced in these cycles. If you don't go in balanced and achieve the same outcome, you get unbalanced very quickly and without the ability to reallocate when you can't really buy or sell. So you kind of just wear you're waiting for a while. Again, office down, 16.4% on a gross basis, a little less if you look at debt, but again, leverage is 27%. So not material. We've seen a number of places where, portfolio managers are saying I've reduced my office to virtually zero. If you've calculated on a net basis, you can also do that by just writing the value down below its debt, and then you have no more office, for example. That's one way to reduce your exposure, but that's why we use gross value so that we can do attribution and that we can understand the true real estate exposure, not just the equity exposure. I think maybe lastly on this page this is, again, the old definitions. I've talked about this before. NCREIF is updating definitions to account for alternative sectors to more closely be able to track performance of sectors and subsectors. So as we go forward, the NCREIF definitions will change. I think we've put this in a number of places. Please feel free to use it, educate, the constituents. I think it's going to be a bit confusing for boards, for CIOs, and really anyone looking at their exposures to see it change from one quarter to the next. It's not going to be huge, and we'll talk about that in a minute, but it is going to be a bit confusing as we go through the transition, I think.
In terms of making apples to apples comparisons.
Yeah, exactly. Under 4Q, your office exposure, is one number, and then the next quarter it's going to be slightly higher, likely. If or at least the index will be slightly higher, because office will include things like medical office and life science. All those two sectors are not necessarily being calculated in office today. And so, I showed you office was, 16.4. It's going to go up a bit if you include those, those property subtypes. And again, some of the other subsectors like senior housing, self-storage will be broken out, but we'll also be able to see through office into these subsectors much more clearly. The shift continues either way in terms of more exposure to those subsectors, which is calculated here as other, just to show the total impact. I think interestingly, we also have not talked about retail for quite a while. We think retail is poised to be maybe the best performing sector in 2025 as a whole. Obviously, subsectors matter, but given the higher cap rates, retail looks pretty attractive. We're hearing a lot of capital have interest again to start accessing it.
Yeah, here's a question from Ann Westbrook, and it's one I actually had in the back of my mind, but didn't think to ask. Can you please distinguish between the life sciences real estate that's included in industrial versus the life sciences real estate that's included in office? What's the difference?
Yeah, well, it's just the use, right? So, I mean, there's clearly office that is medical or life science, medical related, typically. But there is warehousing and industrial life science assets as well that are more.
That would be like flex space.
Yeah, exactly. And there's very little life science industrial. Brian may be able to post the answer here, but it's well under 1%. So it's not a huge, sector by any means. So here's the total changes, 2019 to present. Obviously a big shift. But again, a lot of that shift is coming from valuation, not necessarily 18% of the shift coming from office sales. It's also, a deep value decline. Um, I always like this chart. I think it just shows the contribution of return per quarter by property type really clearly. As much as we dislike office in the current state, it was a huge driver of return and a disproportionately big driver of return in history. So it did have its place. I think
It also is
certain.
safe to say too, Garrett, that office constituted the majority, the largest sector of most portfolio weightings.
Oh yeah, this is absolutely weighted by exposure, right? So the return's one part of it, and then the weighting in the portfolio is the other part. So this is not giving you attribution on that piece of it. It's just telling you what drove my return in this weight based on the weightings. And again, you can see office. I think even interestingly, right, it's the biggest part of the uh, negative returns. But that is even leveling off from a total impact, given how low the exposure is getting. So it's going to be less and less of a conversation just in terms of what matters. And to me, in terms of outcome, the total return in office may be bad, but given it's such a small weighting, it's not going to give me a big impact anymore. Certainly, you can see the other sectors too in the last 2 quarters. We're actually about the same in terms of performance. It was just office and 3Q dragging that total return down by almost 100 basis points. Whereas in this last quarter, office wasn't as negative, so we had a little higher total return. And again, this is the old type. You're going to blink and not see much of a difference, and that's the point here. Here's the new type. So I'll just let people look. It's virtually no difference in terms of impact historically on return, because a lot of the senior housing, self-storage, other is just been added over the last couple of years. And it's just starting to become a meaningful part of portfolios. So, I think it's important to remember, as much as we talk about these other sectors, there's not a lot of history of return. And so it's not clear that they are forever sectors. They certainly have some good attributes and some good reason capital is going there. The question is, does it continue? From a total return standpoint, and this is unlevered, office is down 45% almost. So if you're 50% levered on your office building going into this cycle, there's a good chance your partners with your lender now going forward, or the lender owns it. This is why the lenders are moving slow. They don't have the capital either to release and build these new rent rolls. So it seems that for decent buildings with good owners and well-capitalized groups, they're willing to work with those groups to achieve an outcome that's best for everyone. That's been the case so far. Obviously there's a lot of exceptions to that, and there's going to be a lot of news about different buildings going back and vice versa. But what I think is very clear is, office is going to look somewhat like retail in the retail cycle that we've already been through, where the good and the strong get even stronger and better, and the weak, again, will get weaker and even worse. If you're a tenant, you're not going to a building that doesn't have a well-capitalized landlord that is actively giving TIs and putting capital back into the building. So it's cutting half the stock off, already. And that's a very unscientific number. For the last year, Again, office, leads the way significantly. You can see though, if you look at the fourth quarter, retail, industrial, other were positive. Apartment was flat, and again, that's impacting, disproportionately the ODCE number with office. The question we had was, what's this look like under the new allocations? Um, Office is actually looking a little better. Again, it's driven by life science, which has done better than broader office. But again, pretty much everything else is doing better than ODCE because of the office impact historically, over the last year. I think the thing that we were interested in was of these other sectors, and now that we can look at them and break them out and do attribution, where is that return coming from and how good or bad is it? And again, there's not a huge percentage of exposure here, so I take that lightly. It's not the market of data centers or life science, but data center is overwhelmingly more positive total return than anything else in the alternative sector at this point.
Let me ask you a question about that, Garrett, because if you look at this chart, every single one of the property types on this chart were the darlings a few years ago. And then capital poured in, and some of them got overbuilt. Some of them ended up just underperforming. Why is data centers going to be immune from that impact?
Well,
Or are they?
I don't know. Yeah, I'm not sure I said it will be, but I do think it will be. And I think it comes down to if you look at supply demand, lease and lease structure. So office, life science, life science is office lease structures typically. There was overbuilding. There was easy access to overbuilding, office in markets, if you will, and there was no reason you couldn't say it was life science instead of office. So the the uh, the barriers to entry were low, and the ability for developers to meet the demand and then some was high. And so we have that supply demand imbalance. And the question is, how long does it last? It's still there today, so I don't think it's over by any means in life science. Again, medical office is better than office, but it's not better than zero return wise, right?
Well, the
Again,
story there was demographics, right? It was we're all aging, the baby boomers are going to need more care. There's a need for more medical office, but you know,
yeah, but again, it's supply and demand, right? There's a lot of buildings you can put medical people in. I don't know how to say that better, but again, supply and demand. Single family rental. Ironically, I think this shows you the supply and demand imbalance is the best. Single family housing is, again, I think there's a need. There's a huge, housing need or issue. It's affordability based though. And I think the cost to build it was high over the last few years because of the inflation. Now, again, I think the cost to recreate that single family that you own today is even higher than it was a year ago. And so over time, that'll balance out whether it's single family or resi overall. The demand will be there given the imbalance.
you know what
Same
the,
with student.
you know what the total allocation to data centers within ODCE is? I mean, what percentage of ODCE is comprised of data centers? Do you know?
Yeah, again, these are small subsets. It's like 1% today. It's going to be a couple more percent over time as more is built out, because you need very little capital value to start construction, right? And then it continues to build. So that will build into the index over the next few years and be a positive, story, I think. But then coming back to what makes data centers so much better in terms of return here, I think it's you can't go build a data center on any piece of land that you want, right? You need a lot of pieces to come together. I also think that's going to lead to a lot of disparity in outcome in data centers. If you're taking, just the broad view that everything will be built, I think that's vastly different than what it will be. A lot of land is not going to get the entitlements, is not going to get the power it needs, is not going to be in the right location for fiber. There's just a lot of pieces that limit the supply or the ability to create the supply.
No.
And again, I think that's why you're seeing the return higher. Um, you know, Overall, though, I think diversification is good. Having more subsectors, something has to take the place of that office 40% exposure, in the index. And we have a lot of conversations with, everyone around this. I don't think it's one sector that takes a majority of that allocation. I think it's going to be very diversified. I think this comes back to the conversation around volatility and uncertainty. Some groups are going to lean in much heavier and have much more conviction around any number of these subsectors and sectors. And that's going to be the driver of that volatility. Is there's going to be a lot of different portfolio constructions out there going forward that will lead to different returns and more volatility in our view.
You're talking to a lot of these managers. Should investors factor the risk of technological advancement in data centers? And if so, how are managers approaching it?
Yeah, I think they should. And I think, again, it comes down to lease and outcome. These tend to be longer leases with higher credits. For certain parts of the data center market, like, hyperscalers. And then I think the other place, which is the majority of what's in ODCE, by the way, but the broader market, co-location centers are, I think an operating business, you really have to understand more of that. It's much easier to just have Microsoft figure it out, right, and just lease it and take their credit to them than it is to have 50 different operators in your center and different technologies and different needs. But I think they offer different returns and different risk profiles. So what's clear is the demand has changed because the technology changed. And that's been benefiting data centers. I would be surprised if it changes in the near term. But again, there's a lot of views around that. Maybe I'll switch gears to a little bit of a newer chart. Just this is by count, so this is not weighted by value, which is why the total return's higher. But again, I just think this shows the clear value stabilization in assets today. The red is, driven by office, obviously, because there's a lot of assets, still a lot of assets by count in office, but the values have gone down. But it's a clear trend of of values flattening and then starting to recover again. And I think as we look at the broader markets, kind of coming back to the earlier conversation around capital cycle. The this is showing ODCE total return index to 100. So, about 20% value decline or return difference from the peak. REITs, I think, are always very interesting. I think, they certainly react faster. And you can see, again, I think the public markets are still pricing in a recovery. But REITs have not, appreciated anywhere near just overall stock market in the teal line, which, to put in perspective, stocks are up 70% and ODCE's down almost 20% from a return perspective.
Yeah, as we were talking before, somebody once told me the difference between real estate and the shoe business is that when you mark shoes down, people buy more shoes.
Well,
We,
I think core real estate is on sale today as well.
hmm. Well, David Jacobs has a question. Do you actually think that ODCE will become less volatile over time as alternatives increase in several of the alternative subsectors like self-storage, student housing, medical office buildings, senior housing, may be driven more from demographic trends as opposed to GDP cycles?
Yeah, that's a great question. I think, you know, over long cycles, over long periods of time, real estate as a whole has been really uh, pretty low vol when you look at it compared to other asset classes. I think, you know, maybe as a whole, the index does, benefit more from more diversification, right? But I think it's more just the diversification of more sectors, as you said, and maybe more diversified drivers of performance. I think within that, though, there's going to be bigger weightings and bigger bets placed by each portfolio or each fund, which will drive more volatility because I think um, the benchmark hugging is less and less, and the demand for true repeatable, consistent, alpha, if you will, is higher and more clear and more transparent. So I think that drives more, for active portfolio decisions. The last piece of it, maybe I'll just say is, you know, over, and this is the next slide, ironically. So this is volatility of the property types, the main property types, best, worst performer, each quarter on a lagging 1 year basis, and then fund as well within the index. So one, if you notice the funds volatility in the GFC was really high, but the sector volatility, the property type was really not high. It was actually below average. So like everything in real estate went the same direction at the same time. It was all about asset selection, not asset allocation. Didn't matter how much office or you had compared to your peers. It just mattered whether you had the better office compared to your peers, in other words. This cycle, one, you see the property type dispersion is of it was 3 standard deviations higher, right? That's like a once in a lifetime event. And it was all driven by property type selection, property type allocation. So the last 5 years, when you look at performance track records, it's really hard to differentiate, was the portfolio outperforming or underperforming simply because the weightings were off, meaning over or underweighted to the right sectors, or was real value driven at the asset level through asset management? And about 80% of the return was driven by just getting the weightings right. Like virtually no return was driven by actually doing good asset management. Um,
It
that's
looks like that trend was triggered by COVID. Would you agree with that? And if that's the case, is that a sustainable change or is that just an anomaly?
Well, look, it was first driven by COVID with the impact on retail, right? It was disproportionately big on retail, but arguably the supply and demand and the demographic, like everything pointed to retail eventually having this problem. It was just probably COVID expedited it, right? But now we're talking about office. And again, I think we're in the latter half, or latter stages, not half, but latter stages of the value correction in office. Like we're already down 50%. Just by math, we're probably halfway there. We're more than halfway there. It's not worth zero. So, I think, does that continue or not? And our view is not to the same degree. Our view is it's going to come back more to asset management, growing NOI, growing rent and income rather than just getting the sectors disproportionately right.
Now, you've also been talking about a recovery cycle. And recovery cycles can be strong or recovery cycles can be vulnerable. Do you think this particular recovery cycle is sustainable? And if so, why?
Well, uh, let's talk about a couple of those fundamentals because I think that our base case again is that cap rates don't drive the valuation going forward, meaning we don't see interest rates dropping significantly that just increase asset values again, right? So, and again, that's arguably why the sectors had disproportionately changes in cap rates, which I'll show next. But like, the Fed funds rate, adjusted at the end of the fourth quarter. So at least the Fed funds rate is below cap rates. The historical spread isn't great by any means, and it should probably, needs to be higher over time, which we think will grow into. Okay. But we don't necessarily see cap rates changing significantly. Maybe the Fed funds rate goes a little lower. Maybe it stays the same. Again, 3 weeks ago, there was no outlook for any future cuts in the last week. There's now an outlook for 3 more cuts. So like, I'll come back to that uncertainty and that volatility conversation, right? We'll see. But our view is, it doesn't a lot of it, a lot of cuts don't happen. Historically, the cap rate spread has been driven by interest rate cuts, not cap rate expansion. Again, these assets cost something to build. There is value to them, in a hard asset and in land. You can't just create it out of thin air. So there is a point where the value of something can't go lower, given how much it costs to create it. And that's replacement cost. Said better. So 87% of the spread is created by interest rates being lowered, not cap rates going up. In this cycle, though, cap rates moved at a very disproportionate rate. And there's more to talk about here than that, but you can now see office has the highest cap rate. I'll discuss that coming down in a second. Retail, though, I mentioned, being a positive, it's a 5.5 income yield, if you will, going in. A little bit of growth, get you a pretty good return without that cap rate moving at all, right? And then you just have to think about what's the cost of debt and is that accretive or not to your unlevered return. But again, I think the unlevered return is a new conversation given the cost of debt. It used to be, a no-brainer that everywhere anything you bought could be levered and that leverage would be accretive. That's not necessarily the case anymore. And that's where, cap rates matter. And the cost of debt matters. ODCE around a 4.6. Again, it ticked slightly down because largely driven by that office. That's just the income reducing in office, not necessarily values being changed. It's income coming down. I'll hit on that in a moment of NOI growth. But again, you see industrial kind of settling in around 4, and ODCE overall around 4.6, 4.5. NOI growth. So let's hit that for a minute because I think that is impacting. I'm going to go a little faster here to kind of get to the capital flows, but NOI growth has has remained above inflation until this past quarter, and that's primarily in our view driven by office. And again, we think that may be a kind of a point in time. We'll see how much more this gets addressed, but apartments around 3, right around inflation. Industrial remains high, but coming off its peaks around 7. The last quarter office, was significantly down at -3% NOI growth. A couple things happened there, candidly. One is there were some sales, so what's left pulled some NOI down. And then I think there's also a resetting of a lot of lease roll coming through the office sector. Lastly, retail is around 3, but you have a much higher cap rate going in with retail than the other two sectors. So, our view is retail, apartment, industrial, 1, 2, and 3 total returns for the year. Occupancy, though, I kind of coming back to office, occupancy actually ticked up again in office, again with those sales and some lease roll coming, and tenant signings coming on. So like actually somewhat positive, like in some respects that again, there's more return to office. Not saying we're at the bottom or at the end of the cycle in office, but we are starting to see some better news. Some of the cities are doing much better than they were, like in New York is doing much better, more full. Can't necessarily say that about some of the West Coast cities, but there are some pockets of positive news, and there is even a bit of lending, like the CMBS market is providing some capital to the office sector again, after it literally being zero. So something's better than nothing. So from here, I wanted to get to the capital flows. Maybe the last point I'll just point to is cost of debt. And again, this is not necessarily true across a broader real estate market, but the benefit of low leverage and a lot of fixed rate is the cost of debt remains really stable. It's at 4.5, which is right around the cap rate. So I understand, like, buying new assets today, you can't finance at 4.5. But this cost is a reality of this portfolio, if you will, or of the open-ended fund portfolios, and they have a long runway here. Even if we move this out 4 or 5 years, it doesn't move more than 50 basis points in renewing everything that comes at market. So it's a very stable, limited debt maturities, very laddered. So there's plenty of time, to kind of deal with any office or other pieces of the portfolio you need to.
So if I understand what you're saying, you're basically saying that you may not be able to buy into the market and finance at those rates, but you can buy into ODCE and finance and get a portfolio that's financed at those rates. And there may be a wall of capital out there that's hitting some property owners, but it's not embedded in the ODCE.
100%. And I think that capital is actually coming back to real estate as a whole, and including ODCE funds. It's early, but our platform alone saw a couple $2 billion between the end of last year and beginning of this year. And I think as we look at the underlying funds, we're seeing the same thing, selectively at different funds, but we are seeing early signs that certain funds have, net positive flow starting again. When you look at it as a whole, though, you're not going to see that. Law of averages can not always tell you the full story.
Adriana de Alcantara has a question. Do you have the impact of debt on returns in Q4?
Oh yeah. So I think you're asking about the debt mark to market impact. And that rates went.
You said yes.
Yes. So rates in the Q4 returns went up, and that led to a positive debt mark to market. If they come down and end the quarter lower than the fourth quarter, which never want to make assumptions, but it seems that's the way it's going at the moment. It would actually lead to a negative debt mark to market, but we're talking like 20, 30 basis points either direction, I think, at most. Okay, so acquisitions, dispositions. I think you can kind of hear some of this in other places. So I know people want to see Q. I'll do that quickly. Dispositions, I think no surprise. We did see office dispositions, acquisitions, almost the exact inverse. Net flow. I point to this because net investor cash flow means a lot more or at least on a trend line, more and more capital is being paid out to investors because it's being sold. So you see the gray getting bigger again, the blue even getting a little bigger again too. So again, more cash flows all the way around. Is very narrow, and then it's getting bigger. Same thing in the GFC. You saw almost zero on either end, and then both sides start to grow. So seeing that similar trend. Obviously, dollars today are bigger than they were in the GFC, the index a lot bigger. So you got to keep that in mind. Q wise, we saw the Q continue to come down and at a very similar rate to what we saw in the GFC. Okay. Net
Just
Q.
took longer.
Well, yeah, because the write downs took longer too, right? So we've been in a longer part of the cycle, and that did have us a little perplexed, right? Like, well, one, why, if that much redemption is not happening, why, what the general tone is I'm not getting the redemption I want, right, from investors. But the reality is two things are happening under this number that we wanted to kind of be able to highlight here, which is I kind of assumed that investors would just put in their redemption in like 1Q of 2024, and that was kind of it. But there's kind of three pieces. There's new investor redemptions each quarter. There's new investor rescissions each quarter. And then there's also pay downs each quarter or payouts to that queue. So there's really three components of that moving average. And if you look at the investor impact, it's finally started to shift in the latter half of 24 into much less investor redemption coming in each quarter, more rescission than investor redemption request. And then with the pay downs, the funds are paying, over the last 2 quarters between $4 and $6 billion per quarter in redemption requests. So overall, there's actually a lot more cash flow movement than I think the kind of top line shows or the impact when you add all three up. So yeah, it's I think there's a big concert to get on solid footing in terms of going on offensive with capital, and you can only do that if you kind of manage your redemption queue and get that paid down.
Now, Elena West asked, do you have any intel on secondary trends as it relates to Qs? There have been quite a few secondary trades in the open-end fund market.
There have, multi-billion dollar scale, in secondaries per quarter over the last few quarters, I would say. Certainly with the recovery, they're getting smaller and the spreads are getting smaller, but it's been a robust market. And again, that is part of what I'm referring to with capital coming back. Our fund saw, a couple $1 billion of that kind of activity to the positive, over the last 90 plus days. And, that's the early capitals, coalescing around total return going forward with a head start. I think we're even seeing a fair amount of primary activity, start into 1 and 2Q of this year. So again, the cycle of capital flow back, it's not across the board, but it is happening. And again, 4Q, we saw a bigger pay down, certainly than 3Q, a meaningfully bigger pay down. Every fund's a little different, but, again, positive progress here. So this is always my last slide. With that, I encourage anyone, if you have stuff we didn't cover or want to see new stuff, we're always looking for ideas. Please feel free to send us an email or call and ask. This is for you all, so want to address any comments or questions.
Somebody said, how valuable do you find this type of analysis for investors and managers?
So, I can only just share what people say is, I really appreciate talking to people who say they listen. I find people a lot that, are using this to just give a quick hour perspective on what's happening in their benchmark because, it's meaningful to them. So, we share this. We think transparency will add and bring in more capital, not less capital to, the overall pie for everyone in core real estate. And we find a lot of investors, just in the last couple months, I've done 2 or 3 board meetings for investors talking about ODCE and what's in it. And we're always providing these kind of materials to clients to incorporate into their own analysis.
And another question is, how do investors typically incorporate this kind of analysis into the decision-making process? In other words, how does it influence their decision-making?
Yeah, and the question is, do we have a dedicated team? So Brian Thomas, who's on the line here, is head of analytics. I think that's probably a newer view, or at least not a lot of firms had a head of analytics, 5 years ago, much less, even today, we see a few more. But Brian's been our head of analytics for over more than 5 years. But his team is dedicated to looking at this every day, identifying trends and making sure, we know what we own. Because we own, across the index. And again, we're not making active bets, but we do need to know what we own, and investors need to know what they own and what's in their index. So that's why Brian and his team do this every day.
And there's another question. Hi, Garrett. Thank you for your time and explanations. Can you please touch on what the average data center asset size was that you evaluated, as well as what proportion of these ODCE funds have invested in data centers? So we've already talked about what percentage it is, but what percentage of the 26 funds actually have exposure to the data center sector?
Yeah, less than half today. I think there's some masking, candidly, at the moment around, because it's 1%. So certain funds have more exposure than others, but I think there's some masking we have to be a little careful with in getting into too much detail. I also think there's some different approaches to how different funds are accessing the deal flow and the exposure. So I just, at this point, I'd rather respect their confidentiality around some of those more nuanced details.
Okay, great. Well, listen, Garrett, thank you for the update. It'll be really interesting to tune in 3 months and hear whether the upward trend that we're feeling taking place is actually going to show up in the data. So first quarter, we'll see you in a couple of months.
Looking forward to it, and thanks everyone for their time.
Yeah, thanks everybody for tuning in. We appreciate it. Thank you. Hope this has been helpful.